Agarwal is joining us now. He's head of quant and fund manager at Alchemy Capital Management. Alok, good to have you on the program. Thanks very much for joining us. Prashant this side. Alok, talk to us and our viewers a little bit about, what you do at Alchemy, a little bit of sort of intro, if you don't mind.
Sure.
On the quant side, what kind of work do you guys do? And, it will be helpful. And then we can launch into your views.
Absolutely, Prashant. Quant is one term which has many interpretations in our markets. In the simplest way, the way I put it is when you have a rule-based investing, when the outcomes of the rules decide what goes in and goes out of the portfolio, that's a quant strategy. It could be as simple as just a single line rule, or it could be a complex set of rules having multiple factors and adapting to the market cycles that we do. So that can be a big range. But as long as it's objective and rules driven, it's a quant strategy because mathematical outputs decide what is to be done. It has nothing to do with the short-term trades and a lot of high-frequency trades. A lot of misinterpretation happens around that. That's not what we do. It's purely an investment method, which is decided more on the rules side. Yes, ours is a far more complex method, which tries to adapt to the changing market cycles. That's what makes it quite unique.
In a simple way, can you simplify, well, just to give us a sense, what kind of rules do you have? I mean,
So
yeah.
let's put this way, Prashant, ultimately investment decisions boil down to objective decision making and some subjective data analysis. Objective data revolves around the quality of earnings, the growth of earnings, the balance sheet strength, and some historical numbers. Apart from that, some of the estimates as well, as long as what kind of growth rates are expected in those sectors and companies. So a complex set of rules interacting with each one of them is the set of mathematical rules. But as they say, I often use this example of a coffee machine. A coffee machine can produce, same coffee day in, day out, but it cannot taste or smell its own coffee. There are certain aspects of investment decisions, the subjective data. You need some involvement of human beings into that because mathematics cannot solve it. That's what we believe, that some element of quality ratings on the companies and sectoral sides that needs a human touch. With that, the combination of this complex set of rules and
but these rules are, sorry, just to go on one question more and then we'll get into markets and your view. This is all earnings related, right? It's not momentum, price action. The rules are not based on breakouts, etc. This is quality of earnings, etc. What you're talking about, right?
Each one of them is equally important. So quality of earnings is important. So ultimately, the test of the funds comes in terms of returns as well. So the price movement factors also play a role, but they only play a role. They do not dominate the whole decision making.
Okay, so Alok, let's make it simpler for our viewers then. What is the output that your fund has generated, taking into account the inputs that you are feeding into it qualitatively? So what's the investment advice that your funds, your models are throwing up for the near term and even for the medium term?
So let me put it this way. Broadly, there are three set of factors that we look at. It's quality set of factors, the growth set of factors, and the price action set of factors. Once you evaluate a company in all these three factors, which factor is more important and what will be the weightage of that factor is decided by the kind of strength area that the market is in. A stronger market is almost like slog overs in a cricket match, wherein you need to hit those runs. And that's where the price-driven actions play a far more important role. But markets like the current ones, where there is far more nervousness, far more corrections, and the market's not too receptive of very, very strong movements. And that's where the quality side of earnings and balance sheet strengths, they start having a much larger role to play in the investment decision. So we are currently more on the slightly weaker territory of the markets, trying to bounce back, but still not in a strong mode currently.
So you anticipate more weakness and therefore are you taking cash calls or are there opportunities where there is relative safety? How are you positioning your portfolio and the advice for your clients? What's the advice to your clients?
The advice to the clients is that, these kind of times are the times to actually go ahead and increase allocations to equities. There are certain strange data points. This is the fifth straight month of fall in Nifty 50 as well as Nifty 500. This is the first time it has happened since November 1996. It did not happen during dot-com bubble burst. It did not happen during 2008 crisis. It did not happen during COVID. So yes, the markets were heated up a bit. There was a slowdown in both corporate earnings as well as on the economy side. But sometimes from one end of irrationality, we tend to move towards the other end. Some of those negativities, some of those negative points are possibly little more than the price action is already factoring in. So there's a very big chance of a bounce back happening from here on. But the distance from thereafter will be decided by the ongoing growth in the economy as well as on the corporate earnings, both of which at least there are early signs of bounce back seen in both the economy as well as the corporate earnings.
So which means translates into what? I mean, quantifying it into the index, bounce back from around these levels, a meaningful bounce to take us where? I mean, rough.
So it looks like the major part of the price correction is possibly done with. There are a lot of signs of capitulation also over the last few days. And that the proactive nature of the regulator, especially on the monetary side, that's the RBI, over the last 2 weeks, the way they have been proactively intervening and giving signals to the market is they are ready, they are doing everything that's required to take care of liquidity and the growth sides. And that's actually quite positive. To come out with nearly 1.5 trillion rupees of liquidity answer to that little over 3 trillion rupees of negative liquidity just ahead of budget, then cutting rates, then increasing the OMOs and VRR auctions. These are very, very strong statements to make without those announcements, but very, very strong steps coming forward. At a time when the fiscal consolidation is happening at the country level, ensuring that the balance sheet at the macro level is quite good and quite shock-proof in an environment in the world where a lot of news keeps coming.
So give us a few ideas where we should see this maximum bounce playing out. The majority of this bounce playing out, where should one look for?
So, Prashant, if we look carefully, India was running primarily on the capex-driven growth in the last few years. If you look at the budget side as well, from FY16 to 20, a 7.5% annual growth translated to next 4 years annual growth of 30%. But from FY24-26 is just 8.5% growth. That shift from a capex-driven number to primarily a discretionary spending kind of number is quite visible. So the areas like consumption, especially on the discretionary side, are the ones that are leading the growth and having a far more visibility of a much more higher growth for a longer period of time.
Just a quick, short answer here, Alok. You're saying you're advising your clients to increase allocation to Indian equities at the current juncture. Go all in right now. This is as low as it gets for the near term, or just over the medium term to now deploy money. How would you structure it?
Let me put it this way. We are not somebody who would time the market or say that this is the bottom or the peak. We know this much that, what are the odds that the economy is likely to grow at 10-12% odd and the corporate earnings likely to rebound from single-digit numbers that we saw in the last 2 quarters. This quarter itself is a double-digit earnings growth number that's come for the first time in this financial year. We saw the growth numbers in the GST for 4 straight months was a single-digit growth. For January month has been a 12.4% growth, highest in this financial year. So, there are signs of bounce back in the economy and the corporate earnings growth at a time when the price correction is possibly a little more than warranted. That's a good combination to have when you want to increase allocation to equities. Further beyond that, what should be the exact asset allocation? And that's where the investments need to be. That's what the advisors do. From our side, we are saying that these are the great opportunities to add up to the equity side.
Good conversation, Alok, and look forward to the next one. Thank you very much for joining us here on CNBC TV 18, and we'll spend all of our time next time talking about your views now that we have a fair sense of how you go about running the fund and running your portfolio. Thank you. Well, we'll get you some good news now, actually good news for us and good news for you. The numbers are out. CNBC TV 18's dominance continues.